Welcome to Commercially Speaking, the only CRE podcast where a former Marine and CCIM instructor heroically attempts to teach cap rates to a left-handed theater kid who once asked if IRR was a pirate noise.
You did ask that out loud in front of people.
Yeah. And now I co-host the number 3 CRE podcast in the world, according to a very real and prestigious list that I absolutely didn't make up. Shout out to CREI's 2025 podcast list. Growth Bow. It's called Growth.
10, 9, 8, 7, 6, 5, 4, 3, 2, 1.
I'm Bo Barron, CCIM, former Marine, current real estate investor and instructor.
And I'm Timmy Barron, ADHD. I do comedy. I act. I host this show. I have no business talking about IRAs. But guess what? I'm about to learn so you can look smart at lunch.
That's very generous of you.
You're welcome. Today, we are joined by a guest who might be the most powerful person we've ever had on this show. Not because she owns skyscrapers or private jets, which she might, I don't know. Maybe she does. But because she holds the key to unlocking your retirement account like a damn financial escape room.
She's the head of strategic relations at Madison Trust Company.
Which sounds like the kind of title you get when you're one approval away from running the Treasury.
And she's here to show us how self-directed IRAs let you invest in real estate, private equity, startups, and yes, even alpaca farms, Timmy.
Yeah! She speaks retirement fluently, and yet somehow she makes it feel like we're talking fantasy football, which is a reference I wrote for you, the audience. See, I really am generous.
Very good, Timmy.
She's the IRA whisperer, the queen of custodians, the sultan of strategic placement.
Okay.
Give it up for the one, the only,
Donna Udumulla.
You
I don't know, you tell us.
amazing. Don't stop. Continue. I love this.
All right, well, set us straight. Like, say your last name for us.
Udumulla, you did wonderful. You
You were close enough.
Hey, with the two of us saying it and the pronunciations that we individually did put together, I think it sounded perfect.
My
Sounded like
mom
a
would
duet.
be proud of you guys.
All right.
Thank you.
Absolutely.
Donna, welcome to the show.
Yes,
Thank you
welcome.
for having me. I am so excited. Just so everyone knows here, I am a passive custodian. I do not provide any financial, legal, or tax advice.
There we go.
Please consult your financial professionals and legal counsel whenever making a decision with regard to your retirement accounts.
Absolutely.
And Bridget, maybe we cut that and put it on the front. We've been trying to schedule this for a while and it was earlier this year. We met in Austin, Texas. Timmy's going to ask us how we're connected anyway, so I'm just going to go ahead and tell everybody. But we met in Austin, Texas, which was really cool because I was teaching 102 down there.
Oh, yes.
And they had a big networking event. And out of, some communities, you just have tighter relationships with folks. I've got some really good buddies in Austin, Texas,
Nice.
including our sister.
That's right. She is a really good buddy of ours.
Donna got to meet.
Oh, you
she
met
got to meet
Manch?
Manch.
I met Mary. She's awesome.
Yep.
She is.
She'll kick your ass, but she's awesome.
Yes, she will.
She will. Jiu-jitsu. Woo.
Yeah.
Yep, that's right.
So Donna does that too. So they really connected. But I had Will down there with me as well.
Oh, nice.
And so, at this networking event for the class and the chapter, our good buddy Hampton was there and Penny and some others and my son and my sister and her fiance and her fiance's parents just happened to be at the same restaurant at the same time.
What a group.
And Donna, and she put the whole thing together for us.
Amazing. So
Yes.
you're in Austin.
Oh, I'm actually in the great state of Jersey, actually. But right now, Timmy, all 50 states, I am everywhere and nowhere all at once.
That's amazing. Wow. So I'm excited to talk about what we're talking about because Bo told me about self-directed IRAs. And like we just heard in the intro, I looked it up because I have no idea what that is. And I was, my wife and I talk about this all the time of like the stuff that we have in savings or that, for retirement and things, wouldn't it be great to do something with it? So I'm excited about this topic. However, before we jump into that, will you give us a 5-minute origin story about what led you to do what you're doing now? Like start at the beginning.
So are we going to start when I was born? Because I could, but it's going to be a long story.
Yeah, let's start maybe the day after.
Okay, the day.
Hey, if you're new to commercial real estate investing, you probably know the feeling. Brokers, underwriting, raising capital, where do you even begin? And that's why CRE Investor Coach exists, to give new and emerging investors a clear step-by-step path to closing their first deal. I believe in this program so much, I actually joined the team as an adjunct faculty member. That's how committed I am to helping more people get into the space right now. Whether you want to go at your own pace with on-demand training, launch your first investment with expert coaching, or scale with a mastermind of other ambitious investors, there's a roadmap here for you. Inside, you'll learn how to define your investor identity, analyze deals with confidence, talk to brokers like a pro, raise capital, and build a real acquisition pipeline without all the guesswork. This is about building a business that blesses your life, not breaks your spirit. So if you're ready to stop spinning your wheels and actually get in the game, check out the link in the show notes and start your journey today. Learn, launch, and scale with CRE Investor Coach. This episode is also brought to you by Site to Do Business, commercial real estate's most advanced toolkit, providing commercial real estate professionals like me with premier data, mapping, and marketing tools to win business and revolutionize decision making. Visit STDB.
I have the classic immigrant story, which I'm actually very proud of, really,
Yes.
because it's always a story to tell. But came here to America about 9 years ago with $200 in my pocket and an American dream. So for anyone telling me the American dream doesn't exist, I'm gonna call lies on that one. It does exist. You're looking at the American dream right here.
It does. Nice. This sounds already that opened up like a we're about to watch a musical.
I did not know this, by the way. This is continue.
So, and of course, I came here to be this big corporate lawyer. Came to America and realized, whoa, law school is very expensive. It is really expensive. Took a finance class, fell in love, and I was like, I'm gonna be the Wolf of Wall Street now. That was a quick change.
Yeah.
So once it was all done, my bachelor's, I did an internship at a boutique Wall Street firm based out of New York, and quickly realized this is not for me. It wasn't the stocks or the bonds. It was something was missing, right? When you're doing something like you guys, for instance, there's a passion, there's a drive, and you really want to do it. That was missing. Long story short, somehow I landed in Madison Trust, and I started as a customer service rep. Hey, thanks for calling Madison Trust. This is Donna. How can I help you? And then I realized, whoa, you can invest your retirement money into real estate. You can invest it into precious metals, alpacas, horses.
Right?
Like, what's going on here? And I was like, this is not real. This is a scam. No way. They would have taught this to me in either my bachelor's or my master's, right? Then I did digging, went through IRS code and realized, holy cow, this is a thing since 1975. But something majority of America doesn't know, isn't taught about, no one thinks about it. And that just blew my mind. And the last 6 years at Madison Trust, I've spent eating, breathing, sleeping self-directed IRAs because I really, really want everyone to understand, hey, it's not just stocks and bonds. There's a world out there that you don't even know you can put your retirement money into it, and it's called true diversification. So here we are, Timmy and Bo. That's how you got me here today.
That's amazing. That's amazing. It's amazing to me that if I wanted to, I could invest in a family-owned failing bowling alley in southern Indiana.
Yes.
Right?
That was oddly specific. Like, are you thinking of a place?
Maybe you should talk to your financial advisor before making that decision. Just throwing that out there.
I probably shouldn't. I could. That was a comedy run. The more specific, the funnier.
Okay.
Yeah.
I got you.
So I had ours.
Because we have family-owned failing bowling alleys right here in town. I'm
Right,
sure.
right. Yeah. So, okay, cool. So, How much do you know, Bo, about self-directed IRAs?
Okay, so conceptually, I'm familiar with what they are.
Yeah.
All right, because traditionally, you've got these two types of IRAs:
Roth.
traditional and Roth.
Yes.
And so you put money in your IRA, traditional IRA. You're going to go ahead and pay. You're going to defer taxes
Right.
when you put your money in the IRA, and then at a certain age, you're forced to start taking the money out. And when you take the money out, it's taxed at that point at your tax rate when you're 73 or whatever the number is, which conceivably would be lower tax rate than what you have now. So there's an advantage in deferring and potentially having a lower tax rate back then. Roth IRA, you pay the taxes now and it grows tax free. That sounds awesome.
Yes.
And then these self-directed IRAs, yeah, they're different.
I was like, you're doing so well, Bo. You got it.
Those are my favorite moments.
But it's like,
Well, they're different.
no, but what you can do with self-directed IRAs is direct where the investment goes. Like when you put your money in an IRA, you're kind of confined
Yeah. Okay.
into what you can invest in. It's going to be in securities or bonds or something like that. I don't even know what the rules are, but I know for my IRA, when we put money in there, you know, we've got a handful of options of what we can actually invest in, a mutual fund or something else.
Right.
But with a self-directed IRA, it basically opens up your options and you can invest in things from commercial real estate to alpaca farms, evidently.
Yes. And kombucha companies, if you wanted to.
Yeah.
Donna.
Yeah.
All right. So now I know Roth IRA. You know, Dave Ramsey talks about it all the time. I know it's a good choice, but can you explain to me what is it exactly? Like a little bit more than, go a little deeper than Bo, because who decides where that money is invested or put?
Absolutely. Now, I was going to say, Bo is doing amazing. I was about to give him a job offer after this podcast, be like, hey, I'm hiring you, looking.
I'm a terrible employee. I'm just telling you. Terrible.
Hey, he is.
So basically, guys, there's a lot of brokerage firms out there that is very much in traditional securities. We are talking stocks and bonds, right? Now, they call themselves self-directed too, but they do this thing where they have 3 buckets, whether it's ETFs, mutual funds, whatever it is, you get to pick self-direction. That's not what true self-direction is. True self-direction really is when you are able to, like Bo said, Timmy, you have your retirement money, you have access to it, and you can now invest it into alternative investments beyond traditional securities. So our portfolio of alternative investments is so vast because we have some really creative clients, from residential real estate to commercial real estate to precious metals, cryptocurrency. Yes, we have cattle, Arabian racehorses. We have really interesting stuff like brewing technology, yachts, marinas, airplane hangars, you name it. I have worked with some of the most creative clients, investors there is out there, because that's their passion and they want to invest retirement money into it. Because why? Depending on the right structure, taxes is either tax deferred, that's traditional, or tax free, that's Roth. Traditional IRAs came first, right? Since the invention of IRAs in 1975, Roth came a little later, around 1995, 1996. Roth IRAs is basically, yes, you pay the taxes up front right now. Let's take $100,000 for instance, right? If you have $100,000 in your traditional IRA, Timmy, call me. We are going to convert that to a Roth account. You're going to pay taxes on that $100,000 at your current tax rate. Then the $100,000 goes into your Roth IRA. Now imagine, because this is a real estate podcast, I'm going to use a real estate example instead of an alpaca, because I don't know the appreciation on alpacas right now.
Okay, fine.
Like, I don't know, like, what's their cash flow situation, you know? I don't know that.
I was hoping to learn, but okay.
So we take real estate, we purchase a property for $100,000. Good luck doing that in New Jersey. You can't find a box for $100,000 right now. No, I'm serious right now. You have to go like middle of nowhere, Iowa. Like, seriously.
Yes. Yeah.
Love Iowa, by the way, if anyone's going to be from Iowa, but $100,000 real estate. It's in your Roth IRA. 5 years later, like say this property appreciates to $500,000. Now, this is where it's really amazing, this Roth strategy. That $400,000 appreciation is completely tax-free. And even if you sell, Bo, I see your eyebrows right there. Exactly. Now, if you sell, you do not pay capital gains because you already paid your dues at the beginning for the $100,000. Essentially, the profit, the appreciation, even if you sell or hold on to the property, cannot be touched. Now, I'll stop there because I know that's a lot of information right now for you guys to process. I'm gonna let your brain start churning a little bit.
Sure. I'm with you though. I'm with you. I know what capital gains is.
It's a lot, and what people don't understand is they think this is a loophole. This is not real, but it's not a loophole. This is written into tax code. People just are unaware of how to use it, right?
Right.
I have a question.
Hit me.
We talked about the capital gains part of this.
Yeah.
It makes sense. So we invest retirement savings into a Roth IRA. We pay tax as the money goes in. It grows tax-free because it's self-directed. We can invest that money into commercial real estate, as an example. As that property appreciates, once we sell it, we don't have capital gains. But what about the depreciation side of things? What if we do a cost segregation study and bonus depreciate 30% of that? Can we do that? And when we sell, is there the cost recovery?
I knew you were going to ask that. I knew you were going to ask that. I personally love cost segregation. That is, again, one of those fantastic tax strategies out there that, again, people don't use. However, there's something that the IRS doesn't like, Timmy and Bo, that's double dipping. So the IRS is going to be like, so wait a minute, I give you free, taxes-free appreciation and you want more.
I'm just asking. I'm just wondering.
Right.
So what happens is, typically with cost segregation, the depreciation is written off. Your taxable income gets reduced for your personal taxes, right? Or the entity, whatever you are going to be doing the taxes for. There is these fun things in the IRS regulation called prohibited transaction and disqualified individuals. So you yourself, if you are the IRA account holder, you are #1 disqualified person to your IRA investments. Therefore, you're not able to capture the depreciation benefits from a cost segregation if you purchase your real estate using an IRA. So when clients come to me and they tell me, Donna, so what's the point? Then my question is, okay, you need to first talk to your financial advisor because you know your financial advisor knows your financial situation. They can help you understand, but you need to sit down and run the numbers here, right? So $100,000 property, you're cost segging it for the cost basis without the land, right? Great, but you're doing it at that purchased price. Don't forget, in 5 years, this is going to appreciate $400,000 more. You're not going to be able to cost seg that appreciation, but you are able to get that appreciation completely tax-free. So when you sit down and crunch the numbers, where do you get more of the benefit? Buying it with your non-qualified money, the taxable money, and doing a cost seg and depreciating, or purchasing this with your retirement account, getting the access to the depreciation savings, but now you have $400,000 appreciation that is essentially tax-free. So it's, at the end of the day, it is really up to you and what your goals are about. But it's a great question.
Okay, that makes a ton of sense because it would officially be way too good to be true if you could do all of that at the same time.
Right.
Okay. Now, my mind's just going here. So,
Oh, I love it. Hit me.
like, okay, let's say I have a fund and I'm raising money. Okay. And so, which happens to be the case at Hearthstone Capital, we are actually raising money. And we're taking money from high net worth investors or family offices or other funds or whatever, and then we go look for deals that we can invest in. And let's say we open up a tranche of our fund and we're trying to attract self-directed IRA retirement dollars. Okay. Now, we take some of that money. Can they go into a fund?
Oh,
Say yes.
I love these questions. Yeah, you can. And
Okay, great. So let me just keep rolling. So we could take that money. Great. Love it. And so then we go invest in a deal and it's cost segged and it's bonus depreciated because most of the people investing in the deal aren't coming from the self-directed avenue. And so everybody else wants the advantage. Where does that depreciation go that would have gone to the share of the IRA? And this may be an unfair question, but like, is that depreciation just wasted?
It is.
It is wasted. Okay.
Unfortunately, it is wasted because we've seen that happen, right? Where the K1 goes into the negatives.
Yep.
But again, how are you going to use that depreciation? Because the IRA doesn't file taxes, right? It's the IRA account holder. Now, if the IRA account holder files taxes using that depreciation, the account holder is getting a personal benefit, which is a no-no. That's a prohibited transaction. At no point can you benefit personally. Now, this is where it doesn't make sense, right? So that IRS is telling you, you can invest using your retirement money. You can put it into real estate. And then they're saying, but you as the IRA account holder cannot personally benefit from the investment within your IRA. So make that make sense, guys. So
No, I can't make sense. But let me just back this out a little bit because I was just running a scenario that popped in my head.
Right.
Like, where does that allocation of depreciation, like, where does it just fall through the cracks? And it sounds like it does.
Right.
But if you think about this, going back to her original point, if you invest in something and over the next 20 years, it grows tax-free, and you don't have to pay that capital gains tax at the end,
right?
Who cares about not being able to take advantage of the depreciation? Like, that's still going to be a much better financial situation you'll be in the future.
That's right. And the majority of people that would be investing in real estate through an IRA probably aren't real estate professionals and wouldn't be able to take advantage of bonus depreciation anyway.
Well,
ooh, Timmy. No.
You just demonstrated that you have about 50% of understanding on what a real estate professional is and how that works. That was really good.
Yeah. Okay.
Everybody, you don't have to be a real estate professional to benefit from bonus depreciation. But if you're not a real estate professional, the bonus depreciation just wipes out your passive income, your real estate income. If you are a real estate professional, it can wipe out all your income.
Oh, gotcha.
That's the difference. So everybody can use it. It's just how much of it can you use and against which buckets of income.
Yeah. 50% there.
Hey,
I was 50% there.
That's a lot of progress.
Yeah. But let me ask you guys a question because you guys are the real estate professionals. I am just the self-directed IRA expert. And I've seen this a lot in my travels because thanks to the CCIM community, I feel like I'm a bit CCIM myself now.
Oh, yeah, you're coming.
Yeah, watch the Institute call and be like, yeah, no, Donna, you're not yet. Like, cut that off. But
yeah, you've got enough letters behind your name.
I would like more. Come on.
I know,
Timmy.
right? Yeah, fair enough.
But what I've seen is, guys, I have actually come across a lot of real estate professionals and commercial and residential that don't understand the concept of bonus depreciation and cost segregation.
Totally.
And then I'm here like, my understanding of it comes from the fact that I've gotten this question and I researched it, looked into it, got expert opinions on it, on why this doesn't work for retirement money, right? But it's kind of astounding, but why not use everything? We have non-qualified money, we have qualified money. For your non-qualified money, use bonus depreciation, cost segregation. For your qualified money, that's retirement money. Just find that great deal you want to invest in, whether it's actual tangible property or fund. Either or, if you use the right strategy, it can be tax-free.
For anybody that's listening to this and you're hearing bonus depreciation, you've never fully understood it. Because I remember when we first started this podcast 2.5 years ago, you were like a year or two into really grasping bonus depreciation, right?
Well, before that, it was an intellectual idea.
Right.
But I had just started using it.
Right.
You know, and I
yeah.
was like, oh, this is awesome.
Right.
You know, like, where has this been all my life?
Right. So if you are somebody in that position where this is kind of like, oh, I could use this now. What is this? You can watch this episode here and it's back. 100% bonus depreciation is back. And we talked to both CPA on this episode here. Anywho, I haven't done that in a while.
Nice
to
plug.
the screen.
Mhm.
Okay.
I actually watched your episode on bonus depreciation, guys. Just FYI, wink, wink.
Nice.
Sweet.
Yeah.
Thank
yeah.
you.
The fangirl coming out right now. I'm a compose myself.
Okay, so take me through kind of the logistics of how this works. Okay, I've got a traditional IRA. It's probably a Roth IRA. I don't even remember to
You're
be
moving
honest
it
with
to
you.
me right now, and Timmy, you're gonna set up a account with me too, right? Like I'm just.
Well, yeah. Let's talk about that. I want to. So let's walk me through the process.
Well,
all right?
let's say this way. Okay,
Okay.
so let's say we both have, we'll just use round numbers. Let's say we both have $100,000 in another retirement account, and we're going to move that over and create a self-directed IRA. What happens after that?
Great question. Now, I do want to give you guys a heads up, right? Because we're talking about traditional and Roth. There are other types of self-directed IRAs too. There is SEP, there is simple, there is inherited. SEP and simple are really more like employer-based, like small
Yep.
business IRA accounts. And inherited is, of course, if you got another IRA, someone else's IRA, you inherited after their death. All of the IRA types can be a self-directed IRA. So
Okay.
you guys have an IRA.
I'm sorry, before you get in, can all of them be transferred to a self-directed, regardless of how they were originally set up? Talk to me.
Okay.
This is
Yes.
good news.
Okay.
It's this gives me life when I talk about self-directed IRA. My friends think I'm weird, but come on. This is like awesome. There's $44 trillion of retirement money there. Tell me you're not excited about that. Like
Yeah,
44
that's
trillion.
nuts. That's nuts.
How many commas is that?
Oh
Is
my-
that 7 commas?
It's a 3, 6, 9. 9 commas, a trillion. No, that's a billion. 9, 10, 11. That'd be 12. No, that'd be 12 zeros. 12 divided by 3, 4 commas.
No.
Yeah.
Can we chat GPT this? Like
Yeah, let's get back to Donna taking us through what happens after we actually transfer the money over.
It's 4 commas.
And I'll ask ChatGPT.
It's 4 commas. 44 trillion. You will have 4 commas. I know because I watched Silicon Valley.
All right.
And he was a billionaire and he created his
Could
own.
we just let
his
her
own tequila, tres comas, because he was a billionaire.
Tres commas?
Yeah, tres comas. Yeah. So that's how I know. That's most of my math comes from comedy TV
I
shows.
believe you, Timmy. You know what? You're right. I believe you.
Thank you. Okay. Sorry to interrupt.
Alrighty, let's do this. So you have an IRA at a traditional brokerage or a 401k from a previous employer. You might have been like, you know what, I never did anything, because that happens all the time. 403b, thrift savings plan, all those retirement. Well done, Timmy. Look at that.
Did you see that? Yeah, he confirmed it was 4 commas, everyone. It was
I
4
always
commas.
believed in you.
Mhm.
Just
Thank you.
remember that. I always
Yes.
believed in you.
You have. You've been a great cheerleader for me this whole time. It feels really nice, actually.
It's from the day I met you, which is like 30 minutes.
30 minutes ago.
That means a lot.
So you decide you want to move into a self-directed IRA, right? You have the options here, gentlemen. Full transfer of everything. If it's an IRA to IRA, we call it a transfer. If it's from another retirement plan like a 401k, 403b, we call it a rollover. You set up a self-directed IRA. The process is very simple. We like to keep things simple, 10 minutes, just like how you would set it up with any other custodian. You then, if it's a rollover, you work with your 401k plan admin to roll the funds over to us. So if it's a transfer, you complete, like say, our transfer authorization form, and we'll request the funds from there. Once we get the funds in your IRA, you've already decided, right? Traditional or Roth. Now it's where it gets fun. You must, I always recommend everyone, have a deal ready, because why would you set up a self-directed IRA, transfer the money, and then you're like, okay, everything is done. Where's my deal now? Where's my commercial real estate fund? Or you need to have something in place, right? And then you'll work with the fine folks here. We will do a due diligence. And I want to be very clear about this because there's a lot of misunderstanding. It is not a risk analysis. That is why we always ask you to work with your financial professional, especially if you're getting into a fund private offerings. If one, it's legitimate, because there's a lot of things I've been hearing out there right now.
Oh, yeah.
And oh my goodness, it is craziness out there, right? And it's something that suits you, right? You don't want to be giving up your hard-earned retirement money to something, an equity deal that's not going to come into fruition. Of course, real estate, tangible property always is a fan favorite because like something happens, at least you can go find that, right? You can touch it, smell it, feel it, which is great. So for the sake of this, let's do it. It is a commercial building. You're buying the whole building. You got the $100,000 again, Iowa. There's no other place. Iowa it is.
Iowa, middle of nowhere, Iowa. Yes. Got our $100,000 commercial building.
Did you do like a regression analysis on where it wouldn't be a regression. Did you just do an analysis on where your company has the least amount of accounts and you pick on that state?
No, I am actually. So I am afraid to go and look at this right now. Watch us have like so many clients in Iowa and they're calling me, Donna, seriously? Like, I thought we had a thing.
We love Iowa.
Iowa is, I've been like traveling around Texas for the past 6 weeks, and I always stuck in my head after some conversation where everyone was just beating on Iowa. Don't blame me, blame Texas.
Okay,
Yes,
we'll blame Texas.
So you got the building, right? Great. If you're actually buying the building has the title owner, we'll need the usual closing statements, draft of the deed, purchase contract, all that fun stuff. Certain things are going to be different, guys. So instead of the purchaser being, like, say, Timmy and Bo Barron, it's going to be Madison Trust Company for benefit of Bo, his account number, and Madison Trust Company for the benefit of Timmy and his account number. Because now you're not personally investing in this. Your IRA is investing for you on your behalf. You won't use your social. Your IRA will have an EIN. You're going to be using that. So that's also what gives that tax protection. Yeah. We will sign off on everything as the custodian on behalf of your IRA. You will read and approve everything. Once that's done, we will send the wire to the title company, and then the title company will record the deed under your IRA. So when you actually go to the county property search site, you will see the name is Madison Trust Company, Bo and Timmy, and your IRA account numbers, which is fascinating, right? Because who would have thought you can do that?
Right.
At that point, the asset under your self-directed IRA, Madison IRA, is that building in Iowa. And every year, you can let us know if it's appreciating, what's going on. Now, let me blow your mind a little further, right? There's going to be rental income.
This was my next question. What do we do with the cash flow?
There we go. There's going to be rental income because clearly knowing you fine gentlemen and how smart you are with your real estate investments, it's going to be fully leased, 100% occupancy and all that big words that they use, right?
Right. You're telling me.
You're telling me. I've been hanging out with the CCIM crowd, Timmy, and I'm like...
Oh, the absorption this year was nuts.
The capital stack, right? What's the capital?
IRR.
So you have two options here. One is you can have a property management company because you yourself is the IRA account holder. You shouldn't be actively managing this, and you cannot be compensated personally for it because prohibited transaction. So you can, one, have a property management company. They collect all the rents, pay all the expenses, and whatever is left over, the profits goes back into your IRA. Again, not taxed. You're able to reinvest that any way you want.
Okay.
Fantastic.
Wow.
We have this other thing called a checkbook control model, where we basically set up an IRA LLC, a limited liability company, beefed up with IRA provisions within your self-directed IRA. It comes with a checkbook account, right? We transfer the retirement money into that LLC, and from that LLC, you can purchase that building. At that point, you have control of the rents too. So the money goes back into that LLC checking account. You can continue to reinvest how you want. Again, the tax advantage is protected. Your rents are not going to get taxed. So it just continues to grow as much as you like invest into it. I can see Bo's like head is like spinning. He's thinking.
Well, I just want to make sure.
When the pin is at his mouth,
Yeah.
he's ready to
thinking about
talk.
that.
Yeah.
So the money, the rental income, cash flow of the property goes back into the IRA LLC, which is wrapped up in the self-directed IRA. Pay your expenses. That cash flow, that rental income, the profits from that deal, whatever you want to call it, are tax protected. They're tax free. They're going to grow tax free. They'll go back into the IRA. You can reinvest them into Alpaca farms or another piece of real estate or whatever.
Yeah.
However, this whole time, I think we need to just confirm for me that I'm thinking of this correctly. This is still a retirement account. This is not paying your bills today, correct?
It is retirement account. So that means you cannot at any point take $10,000 out because it's Timmy's birthday. Timmy wants a party.
Yes, a big one.
A big one. So Timmy, if you want that $10,000, you're not to take it out from the LLC. Now, LLC is a different model for people who want to have more freedom and access to the retirement money to invest faster. So like say, forget about the LLC, the rent comes back, the profits come back to the IRA directly. If Timmy wants his party, he needs to take a distribution, request a distribution from us, which we will then give it to him. Now, that's a great question you asked, Bo, because this is where all the legalese comes into play, right?
Mm-hmm.
If it's a Roth IRA, what makes a Roth IRA tax-free? It's not just having it. There is certain criteria to be met. So you need to have the account, a Roth IRA, for over 5 years in existence, and you need to be about 59 and a half years for essentially the proceeds, the appreciation, the investment to be tax-free within that Roth IRA.
Okay,
So once we're 59 and a half and our Roth IRA has existed for at least 5 years, then we can take tax-free distributions.
Correct. At that point, Timmy can have his big party.
And at what age must you take distributions?
So, because we've been talking about Roth IRAs, right? Moment of truth. There's no RMDs, required minimum distributions for Roth IRAs. That is traditional. Yeah.
So you can keep it in there. Okay, interesting. You have to have this Roth IRA at least 5 years. So if I opened up a Roth IRA at 54 and a half years old, then 5 years later, I can still get distributions tax-free because it's just based on the age that you are, and the account's been open for 5 years.
Yes.
Correct.
Yeah. Right. Yeah.
But
Not
you
that
may not
that's
have that much in there because there are limits to how much you can contribute every year.
So,
Is that true with a self-directed?
yes, so we adhere to the same regulations as other IRAs. If you're 50 and younger, $7,000. If you're 50 and older, $8,000. However, gentlemen, if you already have retirement money elsewhere, that's fair game. There is no restriction. So if Timmy has $500,000 stacked up somewhere at a brokerage IRA, that can be converted to a Roth IRA. The whole amount can be used. If you have 401ks or 403bs from old employers that's no longer in use, that can be used too. The rollover. Timmy, I'm gonna send you a job offer too. Call me later. Seriously. Okay. I love you guys. You guys are great.
Okay.
So the contribution limits are if your current income, you want to contribute from your current income to the IRA in that present year.
And you can generally do that up to the tax deadline. So you can make a contribution generally around April 15th
Yeah.
Yes.
for the previous year. So up
Correct.
until April 15th of 2025, you could have contributed to your IRA for 2024.
Gotcha. So if I'm opening up a Roth IRA brand new, right? You've got a limit to how much you can put into that Roth IRA, right?
Every year.
Every year. But the initial amount, is there any limit or
There is. The exception is if you're transferring
if you're right?
or rolling over from something else.
Right.
There's that money's already in these retirement buckets. You can bring it all over if you wanted. Doesn't matter how much.
Right. But if I'm just starting one, like anybody who's like, oh, this sounds like a good idea. I wish I would've done
7,000 for you, 7,000 for your wife.
that. Oh, wow. Oh, God.
You can contribute another 7,000 for Birdie and another 7,000 for Una.
I see.
Yep.
That's why it's a retirement. That's what makes it a retirement.
Yeah.
Things.
I see the
Nice.
fog lifting.
Yeah. Yeah. No. Oh, yes. Okay. Great.
Yep.
So you want to have a little math exercise?
Yes. Yeah.
So
do.
how old is Una? 7, 8,
He's 7.5.
7. Okay, so 7.5. Let's say you start today,
Yeah.
and every year until she's 18. So the next 11 years,
Yes.
you contribute 7,000 a year.
Mhm.
In 11 years, what would you have?
77,000.
No, because retirement income is invested and generally grows.
Oh, right.
But you will have invested 77,000.
Correct.
Right.
Yes.
Now, let's just say at the time she's 18 and you stop doing this for her, that 77,000 is now, let's just say, worth $100,000.
Okay.
Okay. Not a great return, but yeah, okay. $100,000. Now, fast forward that, she puts it into, Quinn's Legacy Land Fund, where she makes 10% a year tax-free on that $100,000
Right.
from age 18 to 59 and a half.
Yeah.
Or, Donna, any chance you're doing the math for me?
I am not. I should.
I got you though. I got you. We're at 100,000 around where she's 18, right?
So that's 10% compounded interest a year from age 18 to age 59. How much tax-free money will she have is the question at age 59 and a half. Because
10% compounding interest every year for, wow. Yeah. Uh-huh.
hold on, me and ChatGPT are going to knock this out.
Wait, I'm actually
perplexing.
chat GPTing this dude. That's 41 and a half years of growth, applying compound, 10%. Oh, it's still going. Still going. Whoa. Okay, tell me if this is right. By age 59 and a half, the 100,000 would have grown to $4.75 million at
Yep.
10% annual compounding.
Yep, that's about right. So
Ooh.
for the next 11 years, you put in
Right. 7,000 a year.
7,000 a year,
Yeah.
and then no more money goes in.
Yeah.
And from age 18, assuming she has $100,000 at age 18, it just grows for the next 41 and a half years
Right.
at 10% interest.
Yeah.
What's the number again?
4.75 million.
4.75.
Yeah. Wow. Yeah.
Yeah.
Oh.
That's
Yeah.
that's the power, and that money is tax-free, by the way.
right.
That's 4.75 million of tax-free money. So that's the power of compounding interest,
Right.
of allowing time, the time value of money, and
Right.
doing this early in the life and allowing it to just grow and
Right.
compound over time, coupled with the self-directed into a land fund or whatever.
Right. Right.
And you
Breed,
pull it
stack,
out.
queens, you name it.
Yes. Wow. Now, and that was even with that had nothing to do with a Roth IRA.
That is a Roth IRA because you paid money on that $77,000 you put in over
Oh.
those 10 years. As you put that in, you're paying taxes on it as ordinary
right.
income. and it grows tax-free. Traditional IRA, you would not pay money on that $77,000.
And also,
But
you're like,
you'd pay when
and-
you get it out.
yeah, and to your point, Bo, for traditional IRAs, those contribution, they're deductible in your tax returns. Roth IRAs, you can't deduct that contribution from your tax return. So there's that give and take. But then, isn't that worth it? Where that $100,000 or $77,000 ended up being $4.75 million. And you're never too young to start it. Now, Roth IRAs, it's better to start early than late because there are income limits, modified adjusted gross income. After a certain level of income, and it changes, IRS provides guidelines every year, you can't contribute directly to a Roth. You have to do a backdoor Roth conversion. So if you start your kids right now, they have that advantage because, let's be honest, they're at the lowest income tax bracket level they'll ever have right now versus later in life, right? So things to consider. And yes, before you guys ask, kids can have self-directed IRAs too.
Heck yeah.
Oh, nice. Yes.
So you can kind of see the power of this.
Absolutely. I absolutely do. Yeah. It's making more sense. Like,
Same.
yeah. Where the knowledge and the things I was taught about compound interest, right? It makes sense about how to apply it.
Yeah, like
Right,
Dad
yeah.
taught us this stuff when we were teenagers.
He taught us what compound interest,
Yeah.
right? I remember seeing that in that little table of like, is this? But he didn't, and if he did, it didn't sink in. He didn't teach me what to do. All I knew was like, if I put money in stocks, you get this compound interest. And that's about as far as it got. Yeah.
Well, you get the compound interest if you reinvest the dividends.
Right. If it
But,
drip, the drip. Yeah. Drip it down.
Yes.
Yeah.
drip.
Okay. All right. Yeah. Drip. Drip.
All right, so this is all very exciting. Who has control? Okay, so a company like yours, we open up the self-directed IRA, we transfer, we roll over, we start making contributions. There's a good amount of money in there. We've got a deal we want to do. You guys, you mentioned you do some due diligence, you make sure that it's legit and stuff. But other than that, like, what guardrails are there in a self-directed IRA? Like, what couldn't I do?
So that's actually a really easy question because the things you are not allowed to do, like the things you can't invest, is much less than the things you can invest in both. So there's 3 things the IRS does not allow you to do. You can't invest in S corporations, you can't invest in collectibles, and life insurance. Other than those 3, everything else is fair game. And trust me, I've had clients come to me with some strange requests, including Brazilian sugar.
Brazilian sugar.
Yep. It's like I said, they really like try to twist everything and try to get through, and technically everything is an alternative investment. Now,
When you say collectibles, are we talking like muscle cars and stamps?
yeah, so like collectible coins and antique
Gotcha.
cars and artwork and fancy stuff. But then, hold up, you can invest into a company that invests into that. You just can't directly invest in yourself.
Aha.
You
I
see,
see.
why I love this, like this very niche part of finance. How
Yeah.
cool is this?
Yeah. It's fun. It's fun.
It's like solving a puzzle every day.
It is. Yeah.
Oh, it's great. Imagine going on a date and all I talk about is, have you heard about self-directed IRAs? Let me blow
Yeah.
Let me blow your mind.
Right.
So Barron Commercial Group is an S corp. You couldn't invest in that.
Right.
So you can't invest into that, but then there's a lot of S corporation that have funds with different entity structures that clients are able to invest into. Either has equity partners or debt partners. That's the other thing. Equity or debt. Did you know if you have a self-directed IRA, you guys can lend money to non-disqualified people from your IRA, and that interest can then again be tax deferred or tax free depending on the type of account.
Wow. So that's not considered distribution.
No.
This is
Because-
what Granddad should have done, is set up a self-directed IRA and loan us money from his IRA.
Right.
Well, see,
right.
Now, that's where now I'm going to come in there, right?
Can't
I
do
mean-
it with family.
So
This episode is sponsored in part by Site to Do Business, the ultimate commercial real estate data analysis and mapping tool. Whether you're a seasoned professional or just starting out, Site to Do Business provides the data and insights you need to make informed decisions and close deals faster. Frankly, it's the tool that I use the most in my business. Access comprehensive market analysis, demographic data, and powerful mapping tools like ArcGIS, Placer AI, and flood maps all in one place. Identify the best locations for your clients, analyze market trends, and present your findings with confidence. Don't miss out on this game-changing platform. Visit stdb.com today and see how it can optimize your business. And now back to the show.
disqualified individual. Certain people in your family, Bo, they're considered disqualified. So siblings, so you guys are fine, which is the craziest thing to me. Siblings are fine. You can't lend to your wife can't lend to you. You can't lend to your children, grandchildren, all that fun stuff. But your aunts, uncles, nephews, nieces, that's fine. So there is a hierarchy of in your family tree that you can lend to versus you can't lend to.
Okay.
Okay, so could we, you can't lend to your kids.
No.
But you could lend the money to me, and I could lend money to your kids.
I feel like I need to put a disclaimer in this podcast right now.
Because we're okay, and nieces and nephews are okay.
All right. Yeah, put a disclaimer and then tell us if that's okay. Absolutely.
And Bridget, maybe we cut that and put it on the front.
She has said that several times. Consult your advisor. But
Yes.
Yeah.
It always is. So what I always tell clients, because they do come up with these creative solutions, right? You always want to ensure there's something called step transactions, right? Where the IRS looks at the beginning and the end. Did you do a lot of things in the middle, steps in the middle to avoid making it a prohibited transaction? So you always want to be careful of that. But technically, can you do that as long as they're non-disqualified people? Yes, you can.
Yeah.
But you guys yourselves are non-disqualified too, so that's completely fine. If ever you're in doubt, guys, and always I tell this to my clients, if you're ever in doubt, that's a red flag that you're in doubt already.
Yeah, right.
Get it blessed by an attorney, preferably an ERISA attorney, an attorney that is well-versed in retirement regulation. I call it bless this mess. As long as there is some sort of an opinion letter, you're protected. Because really, if you take a look at IRS opinion letters, they're very subjective. The same case can have multiple, like the same situation can have different opinions depending on different criteria. So
Sure.
Always ensure you have that legal blessing when you're doing it, especially when we're talking about big commercial real estate projects. That's millions and millions of dollars.
Yeah.
Okay, how can people screw this up? Like, what are some of the big mistakes you see?
So the biggest mistake I see, Bo, is where they get benefited personally. I had this instance, and this happens quite frequently because people don't understand these little, rules and regulations, right? Where, in real estate, husband and wife, realtors, real estate brokers, agents, great. The wife, realtor, would sell a property to the husband's IRA. Now, don't forget, spouses are disqualified. So the husband's IRA now pays commission to the wife personally because she was the realtor in the deal, right? She gets the commission. Now you just committed a prohibited transaction that has been, there's a paper trail of this. Effective 1st of January of that year, the IRA ceases to exist. It is no longer tax protected.
Oh,
So you just...
that's ouch.
Ouch.
But it sounds like
But you're not going to jail.
No. You
Oh.
just lose your IRA money. You get taxed on all of it.
That might
like
be worse.
that could be a massive tax.
Jail is better.
But
me
it
to jail
sounds
for a bit.
like if you were the broker on the deal, my brother, the IRA could pay you a commission. You could lend it to your daughter, who could then lend it to my wife.
Oh, guys, step transaction. What are we doing here?
I can't lend to my daughter.
That's all tongue
Right.
in cheek.
Yeah, yeah.
Oh,
So
you
what-
can't.
No.
So you lend to my daughter,
Right.
who then lends to her cousin,
Yes,
who
my
then
daughter.
lends to my wife.
Right. Oh, we can make this work.
Okay.
Yeah.
Look. Okay. To be clear,
La, la, la.
this is very
Facetious.
tongue tongue in cheek. I am being facetious,
Facetious.
sardonic, sarcastic, whatever word
Yes,
you want to
yes,
use.
yes.
I am playing around here.
Yeah.
Hypotheticals.
Right.
I'm trying to make Donna uncomfortable.
Yes. And
You know
It
what?
helps to-
though? You've met me in person. It takes a lot to make me uncomfortable. Come on.
I heard you go the la la bird a second ago.
That's not uncomfortable. That's plausible deniability.
That's a great
Fair enough.
response. Yeah.
Did Bo Barron and Timmy Barron tell you this while I'm sworn under oath? No, I was saying la la la. I heard
Yeah,
nothing.
la 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 la. But yeah, she was
Okay.
not uncomfortable. That la 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 was like very chipper. La 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 la. Right?
Come on, this ain't my first rodeo.
Well, before we move on, because we're talking about other mistakes, the most common mistakes. Are there any others that come to your head?
So it's really that transacting with the disqualified individual. I think that is the biggest mistake you can do because you really lose that tax advantage, the IRA status of the first of that year, right? That's always the one that I always see. Other than that, nothing crazy other than the fact they're always trying to. This is not a mistake. This is the lack of due diligence. This is why I always emphasize the custodian doesn't do a risk analysis. We're just going to tell you, yeah, you can invest your money into this, retirement money into this or not. That is in no way, shape, or form, guys, us giving a green stamp of approval saying, hey, this is an awesome investment. You should definitely do it because they guaranteed 37% returns year one. Okay, that's a big red flag. The
Right.
other biggest mistake I see is people see numbers and their eyes go, oh my gosh, how amazing would it be if I can get guaranteed 37% return tax-free from my Roth IRA? And then without thinking too much, they're not reviewing who these people are, these investment sponsors are. What's their track record? What's the underlying asset under this fund, right? Who are the GPs in this thing? Like, what's the waterfall structure? What's the years this is actually going to show some cash return? And they invest, and a year or two later, they realize this was never real. So unfortunately, I've seen a lot of that too, where a lot of individuals have been scammed by fake funds, fake alternative investment offerings. And you guys must see this a lot too, right? So fake syndications and fake things around real estate where people's retirement money gets put into it because you can't do it, and then they lose it. It's
You know what I
sad.
see more than anything else? I rarely see somebody who started off to con people. What I generally see is somebody who got greedy, got way out over their skis, put themselves in a situation with investors where everything had to go right, and it never does. And so it crashes and burn really because they bit off more than they could chew, and they took down a lot of people with them. And then when things start to go bad, they bounce.
Yeah.
Like they stop taking calls and stuff. So they didn't generally start out to do that.
Right.
But the character is revealed when things start going south. And
Right.
That's, yeah.
It's
Right.
that's not something that the IRS will be telling you don't do it, but that's something I've seen happen. So other than the prohibited transaction where they do things the IRS says don't do, it's really investing into things that either you don't know or it's too good to be true. And I say guaranteed 37% return is a offering that came across my desk. I saw the word guarantee. I was like, yeah, no.
Oh, boy.
Right. Yeah. No good.
You know, here's the only caution I have about all these things, because I'm really thinking about this as somebody who has an investment vehicle that could take retirement funds through this vehicle that we're talking about. So I'm
Sure.
excited
We
about
didn't even
that.
talk about capital raising yet. Ooh, it's about to get hot.
However, if I'm advising, okay, I'm almost 50. If I'm advising a buddy of mine what he should be doing with his retirement funds, there's an element of this that you want to be somewhat more conservative with your retirement funds. And what self-directed IRA gives you a ton of freedom and allows you to be much riskier.
Right. The risk
in
is
which-
higher,
So I can see how, like,
but so are the rewards.
really, potentially,
Yeah. Potentially. Yeah.
but I can see how really understanding your risk profile and
Right.
projecting, like, hey, we want to be careful here. This is retirement money.
Right.
You know, this is to, yeah. So I can see how there can be mismatched risks
Sure.
going this route. But
Sure. Well, do you have something to say to that, Donna?
Oh, 100%. I agree with it, right? And I always tell people, while my passion is self-directed IRA, do I have IRAs with stocks and bonds? I do. Do I have self-directed IRAs? I do. You never put all of your eggs in one basket, right? Oracle of Omaha, come on. Same thing with this. With self-directed IRAs, you are not going to be putting 100% of your retirement money into a self-directed IRA. Majority of our clients, we have about 22,000 clients, about 80% of them are accredited. And I can tell you right now, they're self-directed IRAs that 10 to 20% of their retirement the whole retirement portfolio that they have diversified, because this is a hedge against inflation, right? This is diversification. They're not going to put everything in one fund and where it's like either we're going to go big or go home. So
Right.
as a sponsor, and Bo, you bring up a great point, because that's the other side of the self-directed IRA coin. You as investors, like Timmy, you get to invest into real estate using your IRA now. Bo, you're an investment sponsor. Now you have the ability to raise capital for your fund using investors' retirement money. Because at the end of the day, why would an investor invest $100,000 with you using their non-qualified money, get taxed, versus they can do the same with their Roth IRA, right? But having those transparent conversations with them to let them know, hey, this is the fund, these are the returns, but there is risks associated with it. But you do have the option of qualified or non-qualified, but you have to make that depending on your risk profile, your financial situation.
Right.
And-
Which seems, sorry to cut you off, which seems like the conversation you would have regardless if it was coming from retirement money or not.
Yeah.
that's true.
Right.
Yeah, a good sponsor is going to have the risk conversation.
Right.
For sure.
Right.
Always.
Yeah.
In fact, I often try to scare people away. Like, you realize this could go bad.
Yep.
I don't think it will. Like, my money's right next to yours in this deal.
Right.
Like, I'm all in. I'm excited about this, but it could go bad. We could lose it all. Like that could happen.
Right.
You know, and so, you know,
It's
yeah,
and
you want to.
it's either all right, you could lose it all, or it's gonna be like the best decision you've ever made. I've seen when the whole crypto. Do you guys remember like 2021 when the crypto was like coming up? We had a few crypto millionaires out of their IRAs, and which was great because they took a chance, and all of a sudden it skyrocketed.
Right.
In the same token, we had a few people who lost everything in their IRAs because they bet on the wrong crypto. So it's really like that at the end of the day. But I love that you brought capital raising, right? So something that now we are, again, we passive custodians, right? So we don't push anyone to go into anything. We actually don't encourage or recommend any investments to anybody because we're not a fiduciary. We don't have that. But we do work with sponsors like you, Bo. We have a bunch of sponsors we work with where we act as the preferred custodian. So when they have investors who want to utilize their retirement money, right? They have someone, hey, we know a custodian, you can go with them. And through that, we raised $246 million last year in retirement money for projects.
Wow.
Now, that's crazy. And think about like the rippling effects in the economy with that much capital like infusion to the economy.
Yeah.
Oh yeah.
Right.
Yeah. I mean, yeah, that's a good point because you're really accessing retirement funds, which are often, not always, but often dollars that are sidelined.
Yep.
And they're just sitting over there and you get to re-engage them.
Right. Right.
That has a significant ripple effect to the economy.
It has a huge rippling effect. You're creating more projects, more job, more income. It's just amazing. And that's why I brought that number up, $44 trillion, right, earlier this. Yeah. Now, it's always going up and down because majority of retirement money is invested in the stock markets and fixed securities. But that's a lot of money out there that if people knew, like, you know, if investors knew that they can use into, like, say, real estate, commercial, residential, anything, they would, because that's the real American dream, guys. Not this.
Right.
Real estate.
Right. So when we came into this conversation, my idea from my brief Google of self-directed IRA was like, okay, I can take what I have in retirement and actually invest that into something. And in my head, for self-directed, it was like, I will come to Madison Trust. That's what it's called. Yes, Madison.
You got it, Timmy.
Yeah. Okay. Yeah. So I go to Madison. I want to transfer my Roth IRA. I want to do a self-directed Roth IRA with you all. And in my head, it was like, okay, here is a list of investments I can choose from, right? That's not the case here. This is like with you who already sponsors, has a fund, invests in real estate. This seems more geared at an investor that's already investing, that knows kind of what they're doing, as another option to shelter their tax.
Sure.
As a tax shelter.
Correct. Exactly. But this is why it's for sophisticated investors, right? Because who gets access to deals? It's the sophisticated accredited investors. Not everyone gets access to like who has the funds and stuff, right? But that's also why like having conversations like this with actual professionals, like fund managers, right? Real estate professionals. It's important because then they know, oh, this is something we can do. My favorite conversation always is, guys, so much joy to me when I speak with financial advisors and they've been doing this for 20, 30 years and they tell me this is a scam, this is fake, this is not real. And I'm like, sir, I'm gonna email you the IRS code so you can read it yourself, because this is absolutely legitimate tax code written in. So it's it's something we just don't talk about.
It's the same thing when you talk with a CPA who isn't familiar with how a cost segregation study works. Now, to be fair, CPAs, some of them are specialists in auditing public companies. They do it, and they don't deal with real estate. Okay, that's a vast. But the perception of a CPA is they know everything about the tax stuff,
right?
Which is unfair to them.
Right.
Okay?
Right.
But you can't make that assumption.
Like doctors, right? You don't want to
just like doctors.
Yeah, you don't want to go to a brain doctor because your heart hurts.
Or
you want to go to
you have an ingrown toenail or something.
Right.
It's like
yeah, that's right. No, if your heart hurts, you want to like get on a dating app or something, because.
I mean, actually, Timmy, don't get on a dating app if your heart hurts. It's only gonna get worse. Just
that's right. I missed the dating apps that came right after I met my wife.
I was gonna say, like, Bo, I think you should cut this spot so the missus doesn't hear. Like, cut that part.
Oh, I didn't say anything about a dating app.
I wasn't talking about me. I was making a joke about a broken heart. That probably means you broke up and you need to go.
We're about to celebrate our 25th anniversary.
Yeah, that's right. That's right. December.
Oh, that's so cute. When December?
Wow.
It's in December. Yeah, December 22nd.
Oh,
yeah.
Wow. She's going to get double gifts. Triple. Anniversary, Christmas Eve, Christmas.
Oh, no, and her birthday's the 29th. It's all in 1 week.
That's all right there.
I get the whole year to prepare for that week. Yeah.
That's right. Yeah.
Yeah, you better get those tennis bracelets out.
I don't get it.
My wife is February. It's there. It's birthday and Valentine's Day.
Wait,
okay.
Timmy, I'm a February baby. When's your wife?
February 16th.
Damn, I was gonna say I'm the 10th.
I'm the 9th.
Bo's the 9th.
I knew I liked you. There was something. Right across the room, we met eyes, and I was like, no, I'm kidding. I actually set up the networking event to meet him. So it was all orchestrated, my grand plan.
Yes. Incredible. The now to get back to this conversation, what are the most common scams that you see people like investing in? is what I'm like. We mentioned it a little bit.
Like what do people need to watch out for and avoid?
Yes, especially today, because there was
Ponzi
mention of
schemes.
Ponzi schemes,
because like a lot of people prey on a lot of unsophisticated investors where they're not able to really review the investment docs to understand whether it's a good investment or not a good investment. They just see those big return numbers, right? And they see the word guaranteed. That happens a lot with like funds, private equity kind of things, private offerings. That's something I've seen happen, not related to real estate, is precious metals. There's a lot of scams out there when it comes to precious metals, where people buy way above spot price, sell below spot price, or they don't even get their metals. Typically, if you buy metals in an IRA, it has to be held at a third-party depository. You can't really physically hold possession of it. And people never get their actual physical metals, which is crazy to me, and I've seen that happen, guys. So those are always, if it's too good to be true, like there is nothing, like it's really too good to be true, trust me, that's something you want to look out for.
Yeah. Well, how do you know what's too good to be true if you've never started investing in things? Yeah,
that's a great question, Timmy.
It'd be hard.
It's going to be very hard, right? Because it's also very overwhelming, especially like we have a lot of younger people going into the workforce, and we see these influencers, TikTok, Instagram, everyone's making millions and you want a piece of that pie. So you're like, okay, I saw this guy on a reel, I need to start investing. So I'm going to start investing. You go to like a little forum, hear about a deal, and you want to get in, and again, the returns like double digits. It's amazing. I want to get into it. It's hard. What I tell people is pause. Okay? Don't ever jump into anything. Your retirement money isn't going anywhere, but if you lose it, you're not getting it back.
Yep.
Pause, take a step back, and really analyze what you're doing. We have great resources now than we've ever had before, guys, between ChatGPT and all these AI things where, trust me, I've tried it myself, where it's a deal where I personally, background in financial analysis, would review it myself. I would put it into an AI to see what the AI would say. And it's not fully 100% accurate, but at least 80% of it is very accurate, where you can learn how to analyze something to fit your financial profile. So for people who don't know, all I say is don't jump, but also don't be afraid. Research, analyze, and if you still can't do it on your own, hire the people who can help you, right? Those financial advisors. Get into there's so many groups and events out there where people are helping people. Like I'm part of this amazing women's real estate investor group, which it's just, I would see every day where a young woman would come in and would be like, well, I really want to buy my first multifamily. I don't know what to do. And 10 people who have like 20 plus doors will jump in and be like, hey, let me walk you through how I did my first deal, and then tell me if you have any questions. And that's the kind of communities you want to kind of get involved in.
Yeah. What I was going to say, before she so eloquently answered that question was, if I were going to invest in cryptocurrency, I would have no frame of reference on what to expect. Not my area of expertise. I know it's out there, but I don't know much about it. And I've pretty much steered clear from it. Well, I've completely steered clear.
Steer clear, big tuna.
So I would walk in with no frame of reference, and I wouldn't know if things are they talking normal returns for this type of investment? I wouldn't understand the risks. I wouldn't know all that stuff. And if I wanted to go that route, I would need to educate myself, and I would need to ask a lot of questions to people who do know that I trust. So if you're wanting to do this and you're looking at a commercial real estate deal, and you have no frame of reference, what you need to do is find people you can trust who do know, who can advise you and educate you and help you along the way, which is essentially what she said.
Yeah, and I think to add to that too, when you see something that's really exciting, or it's really exciting to you because it looks and sounds so good, you lost it. I lost what I was going to say.
You lose your objectivity.
Yeah. So when you go to, when you go to, so another, like, it looks so good, you want it to be real.
Yeah.
So you go and research, and you're going in with a bias.
Oh, that's confirmation bias.
Confirmation
Yeah.
bias.
Trying to confirm that you're right about this,
You're
that this thing is real.
That's
Yeah.
right. You're trying to confirm, and if you are trying to confirm that you are right about something, you will find something to confirm that. So be careful about that, you youngins.
Says the guy who's still in his 30s.
Do not take financial advice from me either.
It is again a little give and a take, but I have seen the benefits of self-directed IRAs, both for investors and sponsors, right? Because creative deal structuring has become a thing now that self-directed IRAs are in the mix for capital raising. Like, how crazy is that? Projects that never could get off the ground because traditional financing from a bank was hell hath no fury. Whoa, I already have a bunch of people, my friends and family, who want to invest into this. I can do this. It's crazy, guys, because a lot of, what's the opposite of youngin? Olden? I don't know. I don't want to offend anyone.
Salty.
Old fart.
Experienced, salty,
Yeah.
seasoned.
I like that.
There, that's good.
The seasoned people out there, they have some giant retirement accounts, like giant. And it is crazy. $1 million retirement accounts that have never seen the light of day.
Right. This is pretty amazing what the ripple effect that this can have.
Yeah.
And the good that it can do if people knew more about it. Why do you think not many people know about it, or why is it not talked about enough from your opinion?
It's, I always thought about that myself, right? Like all like the education we've gotten in finance and everything, no one has ever spoken about this. I really think is because one, it's been there again since 1975, right? But it's just, it seems too good to be true. And also a lot of the big players out there, we are talking Merrill Lynch, Fidelity, Charles Schwab, they don't do this. Why? Because it is risky. The due diligence, and they're fiduciary, by the way, not passive. So when they come into this space, they're going to be conducting a full level risk analysis, and not everything is going to go through. So when the big players don't participate in something like this, it almost becomes like this is not a real thing, but it is.
That makes sense. Like they wouldn't need to participate in something like this because the access to capital that they have.
Exactly.
Right.
But also it's the risk level, right? Like they are fiduciary. They have a different level of responsibilities versus a self-directed IRA custodian has us. Our job is simple. We're going to be the vehicle. So like say, Timmy, you want to invest into a commercial real estate property, right?
Mm-hmm.
You're going to tell us exactly what you want to do, what the properties, where we're sending your funds. We're going to listen to you. We're not going to come right back and be like, listen, Timmy, I got a great property in Nebraska for you right now. Screw Iowa. Like, we're not doing that. We are not doing that. So I think I think that. And then just the lack of education out there, because I do a lot of events, I do a lot of traveling, and every time I talk about this, they're like, whoa, mind blown. And it's overwhelming.
Right.
And it's stressful because all of a sudden you're like, why didn't I know this before? I had a great deal I could have gotten into.
Yeah, I think financial education in general does not do a very good job at teaching people how to make money.
Well, just be smart with it. How to make it, how to keep it, and how to make wise decisions with it.
Right. That's just in general. So you've got something even more niche inside of that.
Yeah.
Yeah.
Well, let's do this. You've done a great job thus far educating us on self-directed IRAs. What are the possibilities? Where are the pitfalls? How does it work? Tell us about Madison Trust.
Absolutely. What would you guys like to know?
Well, we understand you're a passive custodian. You're the vehicle, right?
Yes, you're the vehicle.
But why? I mean, give us the pitch for Madison Trust. Like, how is it different than any of your competitors?
It's very easy. They don't have me.
Right, that's what I was thinking. That's what I was thinking. Yeah.
That's what I was
thinking there. Yeah.
Mic drop. Let's go.
Mic drop. That's it. That is all. That's the whole thing. But no, in all seriousness, why I love working for Madison Trust and why there's so much passion behind this conversation. Not only because it's so cool and interesting, right? Like I'm the star at every dinner show, But it's because Madison Trust was born 11 years ago when my boss, our CEO, Mr. Daniel Gleish, had a self-directed IRA with one of our competitors. He got no support. Like, it was one of his parents' IRAs that he was managing, and it was next to impossible to get good service for what he was trying to do. And he had invested his parents' account into real estate, so he's a real estate investor himself, right? He told me, and I remember he's like, Don, I walked out of there thinking to myself, I'm gonna do this better and make it more affordable for people to access it. 10 years later, 22,000 clients later, $5.5 billion under custody later, that's exactly what Mr. Gleish did. He built a business model where not only can we provide amazing customer service, have these conversations, be transparent, and let you know, listen, I'm not an advisor. I can tell you what you can do, what you can't do. I'm passive, but I can help you try to do what you're trying to do, but also make it affordable. We don't charge based off on portfolio values. So you could have a $100,000 account or $1 million account. We only charge $440 a year, which is nothing for the value of your account, right? And it remains like that. So really, if I have to say why Madison Trust versus others, it's because of our core values. We really want to make retirement accessible and affordable, not just for those ultra wealthy, high net worth investors, but for everyday Americans who are trying to diversify and retire richer.
Yes.
And we've stood by that every single day, guys. I'm very proud to be working for this company, helping send this message out because of our core values.
Now we've talked about, self-directed IRAs here the majority of this time, because that's what you were really interested in talking about, and that's what your special is. Is that what Madison Trust does mainly, or is there more?
So,
or is that the thing?
That's a good question.
That's a great question. So Madison Trust specializes in self-directed IRAs.
Okay, gotcha.
Completely. That is our bread and butter. When it comes to self-directed IRAs, we are honestly one of the top self-directed IRA custodians. Now, the last few years, we have started collaborating with investment sponsors on showing how, when they have investors who want to invest with their retirement money, how they can raise capital better, faster. And of course, we call it the win-win-win situation. You win because you're able to raise capital. Investor wins because investor is able to diversify and get tax-free returns. And we win because we get a client, right? So that's a different angle that we have taken as well, which has stunning results. And then, Timmy, we have a sister company called Roth Financial. Remember that fun little thing I said, Checkbook Control, IRA LLC? Oh, yeah. Right. That's a fun concept. So our sister company actually creates the IRA LLCs for our clients if anyone would like it, but doesn't have an attorney to set it up.
Ah, yes. Okay. This sounds like a win-win-win-win.
Win.
Right? It's a win for you, win for me, win for everyone else. And when is it going to happen? Now.
I see what you did there. All right, one last question, and then we'll land this plane because you've given us a ton of time, and we really appreciate it.
Seeing your handsome faces today was the highlight of my day, guys. I was so excited. I barely slept last night. Plus, I got a lot of calls to make me like, guess who was on Bo's podcast?
Trump recently did an executive order that is forcing 401ks and other types of retirement accounts to now be allowed to invest in real estate, or what it sounds to me like is he's trying by executive order to turn some of these other retirement accounts into something like a self-directed IRA. How do you see that playing out?
So that was a fun one. I feel like this year in general, I don't get into politics. I'm Switzerland. Honestly, I don't even understand politics half the time. It's kind of craziness. But this year has been such a banger after banger after banger after banger for the economy. Some good, some we're yet to find out, right?
Yeah.
That one in particular was an interesting one to me. And I remember the exact spot I was in when I found out, when I got like Wall Street Journal or breaking news, August 7th. I was in Austin. And I was like, whoa, this is interesting. Not a lot of IRS guidelines have been still posted about this. So it's up to a lot of interpretation. My take on it, again, this is just opinion, guys. Just saying, is, it's opinion. So I think what he's trying to do is, we all know he's always been a proponent of alternative investments. He's a heavy investor in alternative investment, whether it's real estate or cryptocurrency. So he has more knowledge on that too. Also, right now in the economy, where is the money in? That's retirement accounts. Giving access to this and putting it at the front face of everything gives you access to more capital, right? These alternative investment projects, whether it's real estate, whether it's whatever, it's fantastic. However, and that's great for us because it's been like crazy to try to get this out in the front for people just to be like, Donna, this is a scam. Like, and I'm like,
Right.
no, it's not. So in one side of it, he just spotlighted out that this is completely legal. This is in tax code. You can invest your retirement money into alternative investment, real estate, for instance. On the other side of it is, I feel like there's going to be a lot of complexities here because 401ks are essentially managed, employer-sponsored retirement, qualified retirement plans. That means there's a fiduciary level there. I have a 401k, my 401k is managed. So my question really is now, let's say you and I, all of us, the 401k owners, right, account holders, we decide to go to our plan admin and be like, I want to buy this office building. How are they going to do the due diligence on that? So that's where I see the complexities, right? So what I foresee happening is, because I know a lot of the big alternative investment funds want to access these retirement money too. So what I see happening, again, we'll find out. Let's rinse and repeat and see each other again next year. This time, is these big funds will now go to these pension plans, retirement accounts, and have them invest into those funds. But it will not truly be self-directed because you're not going to be able to call your 401k and say, I want to get into real estate. You'll just have an alternative investment fund that you can pick and put part of your 401k in. But again, that's my speculation because I just don't see how it working with just all the hurdles of due diligence.
Yeah. Interesting. Because it is like, just like what the question I just asked you, as far as like, how come nobody's talking about this or knows about this much? What just happened with this executive order is now more people are hearing about it and are going to be interested in asking questions and looking to find out more. Right. But,
I could see how it could really help you.
Yeah.
And if people want the freedom to make the call, you're still the option. A self-directed IRA is going to provide a tremendous amount of freedom in comparison to a 401k that has an alternative investment option.
Right.
They could pick,
I think this is a huge win for us as an industry that's always been like the underdog and it's always like struggling. It's funny, like, even though we have a lot of competitors in this industry, we all talk amongst each other and we all have the same problem. How do we get these people to actually understand that this is a thing, right? And then this just pushed us into the front because now when you Google, it's not going to say, oh, you can invest with your 401k. It's self-directed IRAs. This is what you can do. So definitely a win on our end. But I'm very interested to see how the guidelines are going to come in, how the 401ks are going to navigate this new territory because you need a lot of specialists to do the due diligence associated with alternative investments.
Yep,
that's right. And it seems like the other challenge here is the self-directed from your end is actually self-directed, but the other end, you just have a few more out. It's like Uber will take you anywhere that you want to go. However, an airline, you can pick only a few options.
That's a pretty good.
I like that.
Mm-hmm.
I'm steal that.
There you go. Please.
Oh,
Please do.
please.
Or
Please
maybe
do.
even like a train station
Yeah.
A train station.
has
Yeah.
even less options.
That's
Yeah.
right. Or DoorDash. It'll only go to a few spots and bring you the thing.
Mm-hmm.
But Uber, you can get in that car and they'll take you anywhere.
Anyway.
Any place you want. Yeah.
But I
You
do
can
have
use
a
any of
feeling-
those.
I'm gonna use it all, but I do have a feeling that there is more brewing, like in the horizon. I feel like this year we'll have a few more bangers before we wrap it up. Cause
Oh, I think you're right. Yeah.
Oh my gosh. Yeah.
We're waiting, but that was like I said, it's a win for us. I don't know how the 401k plan admins are taking it, Bo, but that's a great question. I was waiting for that question.
Mhm.
Well, I'm glad I didn't let you down.
I know. But real quick, I know before we wrap up, there was one really interesting story I wanted to share with you guys.
Yes.
Yeah. So, are you guys familiar with Peter Thiel?
Yes. Are you?
Yeah. Why?
Is it
Okay.
AI and he like funded
Which one is he?
he and Elon Musk don't really like each other.
Gotcha. Okay. Gotcha.
Oh, there's drama. I didn't know that, but there's drama. So, Timmy, you seem like you know a lot about Peter Thiel. So you're
Not
familiar.
much, just a little bit.
So are you familiar with his investments with PayPal?
Yeah. I think that's where the drama came between him and Elon.
Okay. Let me now blow your minds a little bit, gentlemen, because this was actually one of the things I spoke about this year. I always have these topics I like to talk about, but this year has really been his strategy. So there, 1999, Peter, I think we should be on first name basis now. I don't know him personally, but hopefully soon I will.
Pete.
Peter decided to invest founder shares into PayPal, $2,000. Guess what? Using his self-directed IRA. Roth.
Oh, look.
Self-eggs. Oh my God, I wish I recorded that. Yep, you both just perked up. $1999, $2,000 of Roth self-directed IRAs, founding shares of a private company. Fast forward a few years later, it IPO'd. He got a nice sum of about $50 million, give or take. Peter Thiel is a very sophisticated investor. He invests in high growth potential startups, right? So what he then did is he continued to invest these proceeds into more startup, Palantir being one of them now.
Mm-hmm.
2019, well, 2020, 19 to 2021. Guess how much his Roth IRA that started at $2,000 ended up being? Take a guess.
2 billion.
Yeah. Tres comas.
Tres. One more guess. One more guess.
$10 billion.
$50 billion.
$50 billion. Wait, comma, tax free.
Yeah. So he's actually 57 years old, and he will be 59 and a half in 2.5 years. But yeah. So
This clip is gonna piss off a lot of TikTok.
it's interesting, but that is why the rich becomes rich. They use these financial tools that you have access to, that everyone has access to, you, me, everybody. But
Right.
they use it so smart in a way that at the end of the day, it's like, why didn't we do that, right? But I
Right.
always love bringing up that story because it is just impressive. And I believe Mitt Romney did something similar as well. I'm not familiar with what is the value of his IRA, but he definitely did something very similar as well. So these are the things we all can do as well. Of course, we need that deal, but
Sure.
everyone can do it.
That's right.
The vehicle is available.
The vehicle's available. That's right.
It's
Yeah.
just insane. But
Actually, the vehicle is available for $440 a year.
it is. Can you
That's
believe that?
not a lot of gas money in that vehicle.
That's
You know,
right. No, that's an electric
that's
car right
effective.
there. Wow. Okay. So if anybody wants to get in contact with you, anybody listening right now, where do you want them to go?
So they can go to madisontrust.com. My face is actually plastered all over Madison. So You better get used to saying this a lot, but absolutely feel free to reach out. We have a great group of experts, and I myself love to always talk to anyone who is looking to see if this is a fantastic option as well. But I'm happy to always discuss what sort of creative deal structuring you guys have, as well as use your retirement money to diversify.
Are you on social media? Do you put out any content, educational content and things that people can go and follow at the moment?
Absolutely. So Madison Trust, we actually have our own educational webinar as well, which is fantastic. And we speak about the usual. What is a self-directed IRA? What can you do? The do's and the don'ts. Capital raising with self-directed IRA. Basically, imagine this session broken down into multiple sessions throughout the year. We also bring in investment sponsors who are experts in what they do. Again, it's not to promote the deal, but rather to show people what's really out there.
Yeah. Great.
Perfect.
It's amazing. It is absolutely an incredible tool, guys. But thank you so much for this opportunity. It is fantastic.
Yeah, and if you want to send us how somebody, like maybe a link to sign up for that kind of webinar, we'll put it in the show notes in case somebody wants to further their education.
Yeah.
Absolutely. I will definitely do that, but I'll also be expecting calls from the both of you and your wives and children.
Yeah. Yep.
That's right. Well, you've already met my son, Will, so.
I know.
Yeah. Now, I will also announce that Madison Trust is the newest sponsor of Commercially Speaking.
Well, hey!
Yeah, so
awesome.
I appreciate you really coming on and setting the stage and educating us on what, so that in the future when people are hearing from us about Madison Trust, they understand what the value is and how they can utilize the vehicle.
Absolutely.
I am so excited. What better, like, promoters of Madison Trust or believers of Madison Trust, let me say. Let's cut the promoters out. Let's say believers. Of Madison Trust. Timmy and Bo Barron, CCIM, and actor, comedian.
That's right.
Playwright.
The youngin', the seasoned.
Yes.
Yes.
The youngin' in the season.
The youngin' in the season. Donna, thank you so much. This is very entertaining, very educational. You can clearly see that you're passionate about this.
For sure.
And yeah, this is 44 trillion. Quatros comas.
There's a lot of money out there, guys. There is a ton of money out there. And then investors need things to invest in. And let's be honest, sponsors need money. I really feel like that's like the match made in heaven.
Oh, yeah.
I agree.
I agree.
Yep, I agree. All right. Thank you so much, Donna.
Yeah, this was great.
Perfect. All right, guys. Well,
Donna, thanks so much. You were awesome.
You guys too. Bye.
All right.
Bye. If you made it this far, congratulations. You know more about self-directed IRAs than I did 45 minutes ago, and probably still do.
Big thanks to Donna Udumulla for making retirement accounts somehow feel fun and actionable and slightly intimidating, but in a good way.
If you ever looked at your IRA and thought, I wish this thing could buy a duplex, guess what? It can. Donna just gave you the cheat codes.
Subscribe to Commercially Speaking wherever you get your podcasts and sign up for the newsletter at subscribe.wgbaron.com. We'll send you the latest episodes, deal-making strategies, and the articles that Timmy says he reads but doesn't.
Also, if you want your own virtual executive assistant so good it feels like cheating, go to superpowershq.com/commercially speaking. We're not saying it'll fix your life, but it might buy you back enough time to fake like you've got it together.
And hey, leave us a review on Apple Podcasts because it helps more CRE pros find us, and it gives Timmy something to read when he's feeling fragile.
Which brings me to Barbara Corcoran. Barbara, listen, I know you're busy. You're building empires. You're judging sharks. You're laughing in that way that haunts my dreams, but also heals my inner child. But this is the moment you've been waiting for. Join us. One episode, one mic, one possibly misunderstood improv comedian trying to make his father proud through a audio medium.
Timmy, you are spiraling again.
Barbara, call me. That's the show. We'll see y'all next time on Commercially Speaking.
Love you, brother.
I love you too, brother.
Bye, Alice. Bye, Bridget.
Yeah, baby.